As there's no single investment strategy to save your money, there's not a single path to invest. Index funds, ETFs and mutual funds are an appealing choice for first-time investors or those looking to passively invest their money in established markets. But often, people get confused about what they are and how they differ from each other. Welcome to the From Zero to Wealth channel. If you are new here, this channel provides you easy to understand information about wealth creation through personal finance and investing, teaching you what schools should have. And if you are returning, welcome back. In this video, we'll talk about what mutual funds, index funds and ETFs are, the difference between an index fund and an ETF, and what the similarities are between them. Anyone can use mutual funds, index funds or ETFs to become wealthy, but most of us don't know what they are. So here's what you need to know. Most people use mutual funds, index funds and ETFs interchangeably, and they think they are all the same. I somewhat agree with them because they have their similarities, but it's important to distinguish the differences between these terms. Let's start with mutual funds because this came first. Mutual funds are when many investors put their money together to buy stocks, bonds and other assets. This fund is actively managed by a professional portfolio manager. The portfolio manager decides which company should be put into the fund, which should be removed from the fund, and they actively monitor the fund. So the investors who invest in a mutual fund rely on the portfolio manager's expertise to get the returns that beat the market. Then came the index fund. An index fund is also a fund where investors put their money together to buy stocks or bonds, but this is not actively managed by a professional portfolio manager. Index funds are investment funds that follow a benchmark index. When you invest in an index fund, your money is spread across many companies in a popular index, so all of your investing eggs are not in one basket. The most popular index fund is S&P 500. You've probably heard of this one. The S&P 500 is one of the major indexes that tracks the performance of the 500 largest companies in the US. So when you put your money in the S&P 500, that money is then used to invest in all the companies that make up the S&P 500. For example, these are the few largest companies in the US, and these companies make up the S&P 500. You have Apple, Microsoft, Amazon, Google, JP Morgan, and so on. Let's say you invest $1,000 into the S&P 500. This means that 6.02% of your $1,000 goes to Apple shares, 5.54% goes to Microsoft shares, and 2.31% goes to Amazon shares, and so on and so forth. The goal of index funds is to mirror a particular index. This is why index funds are known as passive investing, and it's what sets them apart from mutual funds. Since index funds don't require daily human management, they have lower management costs. ETFs are similar to index funds and are a fund that tracks on exchanges, generally tracking a specific index. One of the most significant differences between an index fund and an ETF is how they trade. Shares of ETFs trade like stocks. They are bought and sold whenever markets are open. While you can order index fund shares whenever you wish, share purchases only happen once a day, after the market close. This means that the price of any given ETF fluctuates throughout the trading day, while the price of an index fund only changes once a day. If you like this video so far, hit the like button. I really appreciate it. And if you haven't subscribed yet, please do. That will really help my channel. Now let's go back to the video. Another difference is the minimum investment amounts. Many index funds have minimum investment requirements, sometimes in the thousands of dollars. ETFs have no minimum purchase requirement. Until recently, most ETFs were not available as fractional shares. Depending on your brokerage, they still might not be. Index funds, on the other hand, have always been available in fractional amounts. When you buy into an index fund, Managers convert the dollar value of your investment into the correct number of shares based on the net asset value the day of your purchase, regardless of whether you end up with a fractional share or not. So with index funds, you can have 2.78 shares or 5.13 shares, but with ETFs sometimes you can only get full shares, like 2 or 3 shares. Fractional shares have the potential to help you get your money in the market sooner by letting you buy parts instead of purchasing full, pricier shares. This also lets you better take advantage of dollar cost averaging, which may help you pay less per share over time. If you are interested in the dollar cost averaging or you want to know more about it, check out our latest video called The #1 Investment Strategy That Works Regardless of the Market Price, where we explain what dollar cost averaging is, how it works, what the benefits are, etc. Dollar cost averaging like Warren Buffett. I'll put a link down in the description if you are interested. But what are the similarities between index funds and ETFs? All index funds and the vast majority of ETFs use the same strategy: passive index investing. This approach seeks to passively replicate the performance of an underlying index, providing easy diversification and sustainable long-term returns. Here are 3 similarities. Index funds and ETFs provide a simple way to diversify your portfolio. Both offer exposure to hundreds or even thousands of securities, depending on the index they copy. This can greatly decrease the likelihood your portfolio will be adversely impacted by big market swings. According to research, over the past 15 years, more than 87% of actively managed funds have underperformed the benchmarks. ETFs and index funds have outperformed actively managed mutual funds over the long term. Index funds and ETFs generally have much lower fees compared to mutual funds. This is because there's no professional portfolio manager involved that monitors the funds. Thanks for watching this video on mutual funds, index funds and ETFs. By now, you should have a better understanding of the similarities and differences between these investment options. To summarize the differences, mutual funds are professionally managed portfolios of stocks, bonds or other assets that offer diversification and easy access for investors. Index funds track a particular market index and provide broad market exposure with low expenses. ETFs also provide broad market exposure, but trade like individual stocks on an exchange and offer flexibility for investors. Whether you're a beginner or experienced investor, it's important to do your own research and choose an investment option that aligns with your financial goals and risk tolerance. Thanks again for watching, and don't forget to like, comment and subscribe for more informative videos on personal finance and investing.